Over the last year, financials globally have had a pretty good run. Profit margins for lending have grown, and as profits have grown, so too have distributions to shareholders. We've seen this trend in the big banks in the US, but also in Europe, where dividends and buybacks are trending higher and higher. But if the next move for policy rates is down, should investors stick with banks? Today, I'm joined by Antipodes portfolio manager James Rodda, and we're going to look at the setup for financials in the US, Europe, and also Australia, and compare the investment cases for three of the major banks in these markets. Great to have you back on the podcast, James.
Great to be back, Alison.
James, interest rates have been rising for the last 2 years, and banks have done very well. What have you observed?
Look, Alison, I think what drives banks is net interest revenues, losses, and their capital position in the main. And so when analysing banks, the important metric, over the last period of time in terms of what's done well has been all about net interest revenues. So net interest revenue, net interest margin, probably terms we'll talk about a little bit in this episode. So I might just start by sort of explaining those a little bit. So net interest revenue is the revenue a bank receives from the interest on the loans they make, less what they pay to customers for the deposits that they receive from customers. Net interest margin is simply the difference between that lending rate and then what they pay on deposits expressed as a percentage of the value lent or borrowed. So conventional thinking suggests that higher rates see net interest margins expanding as banks can increase the rate on loans faster than what they have to pay customers for deposits. But this only works to a certain extent, and I think that's been the story over the last 12 months. So what we've observed almost unilaterally is that once interest rates crossed a certain point, which was around 2 to 3%, customers started to shop around for higher rates on their deposits. So net interest margins expanded initially and meaningfully, but once deposit costs also started to catch up, the pace of net interest margin expansion has slowed, and in some instances, as we'll talk about during this podcast, it's actually started to contract, and that's happening right now.
So looking ahead 12 months, it looks like policy rates are on their way down. The European Central Bank, or the ECB, has already begun to cut rates, and we're likely to see lower rates in the US and probably the UK by the end of this year. And, it could take a little longer in Australia. But what does a loosening cycle mean for banks?
Look, what a loosening cycle means for banks depends on each market and how many rate cuts we get, Alison. So if rates go all the way back to zero, I think then it's bad news unilaterally. That's unlikely. So if we look at the EU, for example, the rates market saying that rates will fall from a peak of 4% to 2 to 2.5%. And in the UK, it's from a peak of 5% to around 3 to 3.5%. And in this environment where we are constructive on European and UK financials, even in that rate cutting cycle. So as the ECB or the Bank of England cuts rates, the banks we focus on can cut deposit rates and still see net interest revenues grow as a portion of their assets, a large portion being primarily mortgages, roll off onto higher yields relative to where they were fixed several years ago. And we can get to how this works when we discuss specific banks. Before then, the other angle with the European and the UK banks is the capital position. European banks have underperformed for a long time due to regulation. They've had a lot of bad legacy assets on the balance sheets from the 2008 financial crisis that had to be cleaned up, and this took time. The US banks were able to, do that much faster. And pre-COVID, we're in a position where the European banks didn't have any excess capital or any excess cash to distribute to the same extent as US banks. The way to think about this is that a regulator in each country requires a bank has a minimum amount of capital or equity as a percentage of its loans. to protect deposit holders against losses if some of those loans default. So, for example, if the capital ratio is 10%, any equity that's above that 10% level is considered excess capital and can be returned to shareholders as a dividend or share buyback. So back to the EU or even the UK banks, they didn't have any excess capital pre-COVID, but today they do. They're generally overcapitalised and they've cleaned their balance sheets. They've had time to build profits and equity, and with rising rates, also return on equity. So when banks are overcapitalised, that's great because we think banks perform well as they increase their dividend payout ratios and increase their share buybacks. So a great example that we've had in the portfolio for several years is UniCredit. In 2022, it had a market capitalisation of $21 billion. 40% of that was excess capital. Since then, they've made $13 billion in profits, cumulative profits, and this ultimately got returned to shareholders. So if you include the dividends and the share buybacks over the last few years, they've effectively returned that $21 billion market cap back to shareholders. And the market's rewarded the company. The share price itself has more than tripled over the last couple of years. And we see the banks that we own in Europe today, maybe not in that exact position, but in very similar positions with excess capital and rising profits, meaning that distributions and buybacks can be extremely strong.
So it's really important to understand how well capitalised a bank is, because it not only determines how quickly a bank can grow its loan book, but also that outlook for distributions. So you've taken us through Europe and the UK. What about US financials?
Yep, look, it's been a roller coaster ride over there. The US banks have rallied in the last year, and a lot of this was due to receding fears following the Silicon Valley banking crisis. Investors were definitely concerned that would become more widespread. But what we can see now is the net interest margins have peaked last year and have now compressed as deposit costs have risen and customers have shifted money from 0% transaction accounts into 5% plus term deposits and money market funds. As a result, buybacks have been muted, and on top of this, under the Biden government, capital requirements are proposed to go up and become more stringent. But it's an election year, so everything's on the table. If Trump is successful, it is possible the recently announced regulation could end up getting wound back. That said, as things currently stand, we see our collection of European and UK financials achieving total shareholder return yields in the mid to high teens over the next 2 to 3 years. And in the US, those shareholder returns from dividends and buybacks are limited to the sort of mid to high single digits because capital is tighter and they have less funds to distribute. So you're getting double-digit yields in Europe and single-digit yields in the US. And this tells us that Europeans are generally more attractive if we're buying let's say, a similar quality bank.
And have all US banks faced the same degree of deposit funding pressure? And if so, then what does a loosening cycle look like?
No, they haven't. And that's true in most markets. There is some differentiation depending on what the bank is. And from here on, really think about how much they've already passed on to customers in terms of the deposit side, and therefore how much rate cuts they can return to shareholders. So two real world examples: Bank of America with millions of retail customers, even though rates have gone from 0 to 5%, they're still paying on average only 1% on their retail deposits. These are loyal, sticky customers who won't switch banks. But if rates fall, there's not a lot of wiggle room for them to cut interest rates on those deposits from the already low 1% base. And naturally, the net interest margin should contract as they pass on the lower rates to their borrowing customers. Another example would be a bank like Ally Financial, which is a leading auto lender and online bank that offers high-yield online accounts. It's had to pay up to 4% on those deposits versus the 1% the Bank of America pays. And its loans, being auto loans, are generally fixed for around 3 years. So it has faced deposit funding pressure, but in a lower rate environment, it will have more flexibility to cut the deposit rates it pays to its customers, and due to the fixed price loans, it'll also have less pressure on that side of the lending side of the net interest income equation.
So there's just not one rule for every bank, I think is, the conclusion there. Now, James, a significant number of our listeners are in Australia. So can you take us through the outlook for Aussie banks?
Yep. Look, broadly, they've been very resilient, but are not without their own issues. We know the mortgage competition has been very fierce in the last, let's call it 2 years, with new entrants like Macquarie taking market share in the mortgage market. We know that people, depositors have been hunting for yield and shifting money from their transaction accounts to term deposits, like in the US. And finally, loan growth has slowed as higher rates have meant less borrowing capacity on those mortgages. So margins and net interest incomes peaked in 2022 and have since been dropping, and we would see the outlook as uncertain.
Okay, James, that's a great scene setter for us. So let's bring it to life by comparing 3 big banks across these markets. So we're going to take a closer look at UK bank NatWest, which we currently own in our global portfolios, Wells Fargo in the US, which is a bank that we have owned in the past, and CBA, Commonwealth Bank of Australia, which we've never owned. So given we know that you're positive on European and UK financials, let's start with NatWest. Take us through the investment case.
Sure. I think we spoke about this a little bit on the UK podcast that we did a few months ago. Look, the UK is a similar market to Australia in terms of concentration. So the largest 10 banks account for almost 80% of the lending. It's a very well-regulated banking system. It's a conservative banking system in terms of the lending standards since the GFC, and almost 80% of household lending is mortgages, so not too dissimilar to Australia. NatWest is the second largest bank in the country after Lloyds. It has 15% share of loans and a 20% share of the sticky low-cost transaction accounts in the market where people's salaries go. And it's also the largest SME bank in the UK. It generates an 18% return on equity, which we use for banks, let's say, as a good measure of quality of a bank and profitability. To put some perspective on that, that's top quartile for all banks in the developed world. And it achieves this high level of profitability for a few reasons. So customer loyalty and scale. It's also shed all its trading and investment banking business post GFC. And today it's predominantly a simple domestic retail bank doing bread and butter mortgages and SME loans, which are highly profitable and where they have a very strong market share. So rates in the UK are 5%. They're likely to be cut over the next year. So why are we bullish on NatWest? Well, what's unique about the UK market is that most of the mortgages are typically 3 to 5 year fixed. This means the household is still only paying around 3% on their mortgages. So even as the Bank of England starts to cut rates, we'll see mortgages that were fixed at lower rates of 3% or perhaps below a few years ago start to roll off and reprice onto the current 5% or more over the next few years. So that lending side of the portfolio can actually have, let's call it higher interest rates. And on the other side, as policy rates fall, deposit rates will also fall at the margin, reducing NatWest's cost of funding. So we think even with the BOE cutting rates, NatWest's net interest margin should be expanding as what they will earn on their mortgage rates grinds higher, but what they pay on their deposit rates also falls. Mortgages are 50% of their loan book, and this will have a pretty positive impact on their revenue, earnings, distributions, etc. We think they can compound earnings at 15% per annum on average over the next 3 years. They've got excess capital at 13.5%, which means they should be able to distribute a significant portion, if not 100%, of their earnings. And at the single-digit price-to-earnings ratio, that means you've got a dividend yield of 7.5%. You can also see 5% of the 5% of the shares bought back each year when you're buying this bank on around 6 times earnings.
That's a meaningful reprice in the cost of mortgages in the UK, isn't it? So going from that fixed rate of, as you called out, around 3% or slightly lower, fixed a few years ago, and then rolling off onto close to 5% today. So could this, given that extent of the repricing, could this lead to a more persistent default cycle at a time when there has been a lot of pressure on the household from rising cost of living?
Yeah, look, I think the cost of living pressure in the UK is definitely been there. Inflation has come off significantly, which is great. In terms of loan losses, the UK regulator has been quite prudent. Mortgage lending is generally capped at 4.5 times your income in the UK, whereas Australia, over half of lending's above that number. There's a significant segments of the market above 6 times income. Over 90% of mortgages in the UK are owner-occupied. There's no negative gearing and less investor lending and speculation, so household leverage overall is much lower. If we look at the NatWest customer base, half their mortgage debt is held by the top 2 deciles of income earners. And UK households overall are still saving 10% of their incomes versus 5% pre-COVID. Whereas in the US or Australia, it's now, say 3% versus 5% pre-COVID. So the UK cumulative excess savings since COVID are at a record, whereas the other countries we've mentioned have started to, draw down and deplete their consumer savings. Lastly, in terms of loan-to-value ratios or dynamic loan-to-value ratios, which is how much outstanding owed on a mortgage versus the current market price of the home value. It's now below 60% in the UK, similar to what we observe in Australia. So house prices need to fall by more than 40% before the bank's equity or the bank's loan is impaired. So if we put all those factors together, we're very comfortable with the quality of the underwriting and the buffers in place at NatWest. And the default cycle and credit risks are lower down the risks of concerns that we have for NatWest.
Really good overview. Let's cross the Atlantic to the US. Wells Fargo. Wells has had pretty good performance over the last year. But it recently reported their second quarter results and net interest revenue fell short of market expectations and the stock fell 6%. So what are you seeing here?
Look, I think Wells is emblematic of the earlier problem that we spoke about. So when rates went from 0 in the US in mid-22 to 3-4% in mid-23, the net interest revenues initially grew by nearly $12 billion per annum. But they've since given up nearly 40% or $5 billion of this as they've had to increase their deposit rates as customers have shifted to higher yielding deposit accounts. Wells has also previously had compliance failures, which saw regulators ultimately cap the size of their asset base until they rectified those issues. And that's why loan and deposit growth in the past year has been flat. That is, that they're not growing. So on the back of this, the company expects their net interest revenues to fall 9% for the full year 2024. Looking at capital ratios, as we did previously, they're around at 11% mark. So that's bang in line with where they need to be. But remember, before we expect tightening in US standards, current government policy. So if that's not reduced, excess buybacks and higher dividends are unlikely. And they haven't bought back a lot of stock in the last year, and management guided on the recent call due to capital requirements that there will be muted buyback activity going forward.
Any silver linings for Wells?
Look, it is that there is growing expectation that the regulatory environment may end up being softened, irrespective of who the next US president is. Now, it's not certain, but if it does end up transpiring, Wells could have more flexibility around distributions than what I suggested above. Some of this is starting to be priced in, that's for sure. But it is important to recognise that if the US does wind back regulation, it's likely that Europe and other markets will also follow suit. And those banks do have higher starting capital positions, and it's any benefit is also not yet reflected in their valuations.
Finally, on our own home turf, Australia's largest bank, CBA, probably in every Aussie super fund. How does it compare to the other two giants that we've discussed?
Well, Alison, look, I'll admit CBA definitely is a high-quality retail bank. 25% share of Australian mortgages and deposits. That's best in class across developed market banks. It's got great tech, a great consumer and customer-facing apps and features, a good brand, and it's viewed as, rightly as a high-quality stock. But the reality is in developed markets, the only bank that trades on over 20 times earnings, and the return on equity at 18% is bang in line with NatWest. In terms of the fundamentals for CBA, look, consensus is there's almost no earnings growth over the next 3 years. And so we look into why this is the case. Firstly, it's only sensible to assume that rates in Australia will get cut sometime over the next 2 to 3 years, which will drag on their margins. Secondly, retail banking is around half of CBA's profits, and they've had that dominant 25% market share in mortgages for an extended period of time, with the moat built on the strength of their branch networks and customer franchise. Since COVID, they've seen ongoing share loss and margin pressure as mortgage competition continues to be intense. If we tease out why that's happening, mortgages are a stable, profitable product in Australia, and others want a piece of the pie. So if we take Macquarie, for example, where retail banking is less than 20% of their profits, they've invested a lot in digital, become fully digital without the same cost base as CBA. They've advertised heavily, they've priced very sharply on their loans, and they've grown their share by 2% since COVID. But at 1/5 the size of CBA in mortgages even today, they certainly have more room to take share. The same can be said for ANZ, which is half the size of CBA in mortgages, clearly have ambitions to grow. So, look, the thing is, overall, you've got CBA with near zero earnings growth over the next 3 years. That's also pricing in a period of good credit to continue. So what happens if there's a blip? We'd argue that the macro outlook is uncertain and not without challenges. Migration recently halved from the record we had in 2023. Will there be another rate hike, rate cuts? Not all of it's necessarily good for margins. Rate cuts, alleviate mortgage stress on those higher, more recently originated loans. In terms of where we think about the stock more broadly, are there any buffers, and what are we getting paid to take the risk? So in 2019, CBA paid a dividend of $4.30. Last year in 2023 was $4.50, or 5% higher in the COVID period. The share price is 60% higher today. Their capital ratio is around 12%, so adequate without much excess. So you're looking at, over the next 3 years, no earnings growth, a flat dividend yield of around 3%, without much room for excess capital to be returned by buybacks. That 3.5% dividend yield is less than what I can get domestically in certain high yield savings accounts. So we see the case for good bank, but fully priced.
We've covered a lot of ground, James, and in our investment process, we're looking for companies that have multiple ways of winning and are priced with a margin of safety. So pulling it all together, how do our three contenders, we've got NatWest, we've got Wells Fargo and CBA, compare on that basis?
Sure. So basic summary, NatWest is a good quality, resilient business. It's a well-capitalised bank, very strong market share, very profitable ROE, 18%. It's priced at 6 or we think below 6 times earnings, given the excess capital. We expect it to grow 15% per annum on repricing of their asset book. It has a high dividend yield approaching 8%, with buybacks on top of that, and potentially can go much higher. So we think that's a great investment. Wells Fargo isn't as good a quality franchise as NatWest or CBA. ROE is a bit lower at 14%, but the net interest revenue is falling, and there's a good chance it will continue to fall as deposit costs have risen, and the size of the loan book is capped. So we're not seeing loan growth, and without loosening of the regulatory framework, distribution yield now looks low. The dividend yield's only 3%, for example, and it's more expensive on a price to earnings ratio at 11 times earnings for the lower quality profile and the lower distribution profile. Commonwealth is the most expensive of the group. It's priced on above 20 times earnings, 23 times earnings, perhaps. Earnings aren't growing, however, and the yields, are fairly low, 3.5%. Like NatWest, it's a high quality bank. Both have that same ROE at around the 18%, but you're paying about 4 times the multiple. So we don't see any margin of safety. So under our framework, NatWest leads on resilience, growth potential, and also valuation.
And that final summary of pulling it together at a broader level, in Europe and the UK, you're seeing net interest revenue can grow even as policy rates fall. The banks are generally overcapitalised, and you're seeing a 7 to 8% dividend yield with the potential of an extra kicker from buybacks. And then to compare to that, in the US, question mark over how quickly these banks can grow earnings with the potential for tougher capital requirements. And that impacts how much US banks can return to shareholders. And again, comparing that dividend yield, US banks could be half that of the Europeans. I mean, what else would you add, or is there anything else to add to that summary?
No, I think that's a great summary, Alison. But we're overweight European and UK financials. There's a lot of moving parts. I think we do have some US banks in our let's call it our shadow portfolios that we're watching really closely in the US. The regulation there is potentially changing. Interest rate pathways are uncertain. There's always opportunities per the Alley Financial where no two banks are really, impacted in the same way via changing rates or changing policy settings. So we're always assessing where there is mispricing on opportunity for meaningful upside, but at the moment we see that more clearly across Europe and the UK.
Thank you, James. Thank you so much for your time today and sharing your insights.
Thanks, Alison.
For further information on Antipodes, head to our website antipodes.com, and you can also follow us on LinkedIn and Twitter.
The content in this podcast is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Stock commentary is illustrative only and not a recommendation to buy, hold, or sell any security.